Have you ever stopped to consider why the most influential financial institutions in the world are suddenly pivoting their entire strategies away from the US dollar and into physical assets, even as the mainstream media continues to tell you that the economy is on a soft landing path? What if the reality behind the curtains is far more devastating than any headline is willing to admit, and we are actually witnessing the final stages of a debt-based monetary experiment that is reaching its mathematical breaking point right before our eyes? Today, we are forced to ask the question that no politician wants to answer: how much longer can the United States continue to add $1 trillion to its national debt every 100 days before the global confidence in the full faith and credit of the dollar completely evaporates? This isn't just a theoretical debate for economists in ivory towers. This is a direct threat to your purchasing power, your savings, and the very foundation of the financial future you have worked so hard to build in an increasingly unstable world. Most people are waiting for a crash that looks like a sudden cliff, but they fail to realize that the real crash is a slow, agonizing erosion of value where your money still exists in your bank account, but it simply buys less and less with every passing hour. As we look at the current state of the global markets, we see a massive divergence between the paper economy of Wall Street and the real economy of hard assets, signaling that a massive correction is not just possible, but inevitable. The Federal Reserve is currently trapped in a liquidity paradox, where they must choose between saving the value of the dollar by keeping interest rates high, or saving the banking system from collapse by printing more money to cover the skyrocketing interest payments on the national debt. For the average investor, this means that the traditional safe havens of the past, like government bonds, are now becoming in certificates of confiscation, because the yield they provide is consistently lower than the real-world inflation that is eating away at the core of the economy. This is precisely why we are seeing gold and silver decouple from their historical relationship with the US dollar index, as investors realize that the fiat currency system is being sacrificed to keep the government solvent for just a few more months. If you're watching the daily fluctuations in the gold price, you are missing the forest for the trees. The real story is the massive migration of capital from promise-based assets to reality-based assets that cannot be printed, deleted, or devalued by a central bank's keyboard. The world is waking up to the fact that you cannot solve a debt crisis with more debt. And the only escape hatch for those who understand the math is the precious metals market, which has stood the test of 5,000 years of human history. Why is it that every time the US Treasury holds a bond auction, the demand from foreign nations seems to be dwindling, forcing the Federal Reserve to become the buyer of last resort for its own government's debt? This hidden monetization of the debt is the ultimate fuel for a long-term bull market in gold and silver, because it signals that the supply of dollars is destined to increase exponentially, while the supply of physical gold remains constrained by the laws of geology and physics. Silver, in particular, is facing a double whammy of demand, as it is simultaneously needed as a monetary hedge against inflation and a critical industrial component for the entire green energy and artificial intelligence revolution that is currently sweeping the globe. The silver market is so small and so highly leveraged that even a minor shift in institutional interest could send prices into a vertical short squeeze that makes the GameStop or AMC rallies of the past look like minor blips on a radar screen. We are seeing record-breaking withdrawals from the COMEX and other major physical exchanges, suggesting that the smart money is no longer content with paper promises and is demanding physical delivery before the window of opportunity slams shut. Understanding the debt-to-GDP ratio is critical for any serious trader, because once a nation crosses the 130% threshold, historical data shows there's almost no way to return to stability without a massive devaluation of the currency or a total systemic reset. The United States is currently navigating these uncharted waters with a compass that is broken, relying on outdated economic models that don't account for a world that is actively looking for alternatives to the petrodollar system, as the BRICS nations and emerging economies develop their own gold-backed settlement systems. The global demand for US dollars will naturally decline, causing those trillions of offshore dollars to come flooding back to American shores, creating a domestic inflationary spike that the Fed will be powerless to stop. In this scenario, gold isn't just a commodity that you trade for a quick profit. It becomes the only form of international neutral liquidity that allows you to move value across borders and across time without relying on a centralized clearinghouse. This is why the central banks of China, India, and Poland are buying gold at a pace not seen since the late 1960s. They are preparing for the end of an era and the beginning of a new asset-backed global order. Technically speaking, the cup and handle formation on the long-term gold chart is a multi-decade pattern that suggests a price target so high that most people would dismiss it as impossible. Yet the fundamental data supports every bit of that bullish thesis. When you adjust the price of gold for the massive increase in the M2 money supply, you realize that gold at its current levels is actually cheaper today than it was in 1980 or 2011, meaning we are still in the early innings of a generational bull run. Most retail traders get shaken out of their positions during a 5% or 10% corrections, not realizing that these are the health checks of a bull market that are designed to transfer wealth from the fearful to the informed. You must develop the institutional mindset that views every dip as a gift and every period of consolidation as an opportunity to build a larger position before the next leg up begins. The volatility in the silver market is even more extreme, but for those who can stomach the swings, the gold-silver ratio is screaming that silver is the most undervalued asset on the planet right now, trading at a fraction of its true replacement cost. The industrial reality of silver is something that many finance-only analysts completely overlook, failing to realize that silver is the most reflective and most conductive element on the periodic table, making it irreplaceable in the modern technological age. From the sensors in autonomous vehicles to the photovoltaic cells and solar panels and the massive arrays of servers powering AI, silver is the indispensable metal that the modern world cannot function without, regardless of its price. Unlike gold, which is mostly stored in vaults and recycled, a vast majority of the silver used in industry is consumed in tiny quantities that are not economically viable to recover, leading to a permanent depletion of the world's above-ground stockpiles. This means that we are heading toward a physical shortage where the price of silver will have to rise to a level where industrial users are forced to compete with monetary investors for every single ounce available. When you combine this industrial desperation with a monetary panic caused by a falling dollar, you have the perfect volatility storm that will redefine the meaning of high RPM gains for those positioned correctly. If you are waiting for the mainstream financial news to tell you when it's time to buy, you are already too late, because their job is to keep the majority of the population inside the burning building while the exits are still passable for the elite. The banks like JP, Morgan, and Goldman Sachs have spent years being fined billions of dollars for spoofing and manipulating the precious metals markets to keep prices suppressed while they accumulated massive physical positions behind the scenes. Now that they have filled their coffers, the incentive structure has